In this video, we're going to talk about Camber Energy, trading under the ticker symbol CEI. Before today's video begins, if you like what you see, please consider to like, comment, and subscribe to my channel. During the latest trading day, the stock of Camber Energy has been recovering and holding the ground, very soon after the short report from Kerrisdale Advisors and the announcements of different law firms starting class action lawsuits against CEI dropped. This is going to be an interesting stock to follow up, and in this video we're going to talk about whether Camber still deserves your trust and faith in the video. Essentially, CEI is currently under attack from two fronts. The first one is from short sellers and the second one is from legal firms. Let's begin with the legal firms because it's more recent. The stock has been trending online because retail traders decided to massively support the company against short sellers. So, regarding the legal firms organizing class action lawsuits, I believe that this is just what legal firms do, really. They hope that they can get something out of it, but usually legal issues don't really trigger any turmoil in the financial markets, unless the name of the company is Nikola. Essentially, I think that legal problems are going to fade away, and before long, we would probably not even remember that they existed in the first place. We have seen it with Lucid Motors, we have seen it with Fubo, so stuff like this don't tend to stick on that much. When we look at the volume, it is pretty clear that the bulls are trying to take back control of the stock. And if the volume continues to be near the current level, I believe that it's a matter of time before they can reverse back the tide. Also, the momentum of CEI was put under a lot of pressure recently because there was a report released by Kerrisdale Advisors. This resulted in an increase of short position, as well as the decision of some retail traders to sell their positions. This is a key element to understand. The report stated that the company is about to go bankrupt, that it was misleading investors, that it was a big mess inside out, and so on. Except the thing about this report is that as I read it, I can't stop but to compare it with the reports from Hindenburg. Let's just say that in terms of quality and the professionalism, it's a bit like comparing the New York Times versus Daily Mail. And what Kerrisdale wrote isn't exactly New York Times. Even if I manage to convince myself to read it from the beginning till the end, without judging too much on the form, the substance itself also doesn't really bring forth any sort of significant information that convinces me that there's something significantly fishy with CEI. Yes, it's on shaky grounds. Yes, it's a small cap, but these elements should have been priced in already when we decide to trade with a company like this. I believe that we gotta be careful regarding short reports like those, especially when they come from institutions with vested interest in the outcome and when the report is written in such a poor quality. Overall, I think that retail shareholders are holding the stock pretty well, and if the short sellers have to recover, then this stock can really have the potential to surge in price, possibly going above $4 or $5 or even more. If you're getting in now, I believe that the price point is at a very interesting level where it can find a lot of support because it managed to stay at around $1.72 for almost 4 hours. This is why I think that buying it now may be a decent entry point. I would suggest to keep the position below 1% of your portfolio. Looking at the current environment, I think that we have to be careful with having exposure on the equity market. The market has been predicted to eventually go through a major pullback or even a recession for more than a decade at this point. After the QE years and a drastic increase in asset price and a corresponding crash in their yields, we have to remember that the market is not the economy. One doesn't mirror the other. Otherwise, we would have seen the financial markets trading sideways for more than a decade. 2020 saw another big push in asset prices, and this time not just for the blue chips, but also the growth stocks. There are, generally speaking, two explanations. The first one is that the QE money has been pushing asset prices up, but this tendency is slowing down, especially with them wrapping up in North America and in Europe. So in the future years, it won't be the main force driving the asset prices up, or even keeping them at the same price. On the other hand, this decrease of new money is partially compensated by the geopolitical tensions across the world. And the more tensions there are, the more money there tends to be flowing to the US because it is perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoils or social unrests. What this means for the market is that the degree of uncertainty will increase over the next month, especially as people are expecting some sort of pullbacks or recession after the big volatility that we've had in 2020 and 2021. And the recent announcements from the US Fed, as well as the movement of other asset classes, kind of want to make me feel to keep my speculative plays at a reasonable level. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.